Hi class, this is Janine Miranda and today I'm going to show you how to calculate unemployment insurance tax. And the reason why I did this today was because I wanted to see maybe one of you might have your own business in the future. And this I'm just giving you a little bit, just a little tiny bit of what payroll consists of. So let's go ahead and introduce you to what is unemployment insurance tax. So the Federal Unemployment Tax Act is a piece of legislation that imposes a payroll tax on any business with employees. The revenue it generates is allocated to state unemployment insurance agencies and used to fund unemployment benefits for people who are out of work or disabled. So let's take a look at the federal unemployment tax and the state unemployment tax. Which is FUTA and SUTA for short. Now federal is based on zero is 0.06% and the state is going to vary. Why? Let's say if your employer keeps laying off people all the time and those employees are going straight to the unemployment office and collect and draw a check. It's going to cost that state program a lot of money and his rate will be high versus an employer who doesn't lay off employees all the time. So if he turns this as, if he's good to his employees, pays his taxes on time and in full, then he gets a break. He'll probably end up with a 5.4%. But every state is different. Now the federal says that we as employers must pay taxes on $7,000 per employee per year. This is the base, $7,000. So I'm going to give you an example of 3 employees. Let's start with employee A, employee B, and employee C. Employee A makes $400. Employee B makes $700. And employee C makes $900. What we do next is multiply by 13. Why 13? Because there's 13 weeks in a quarter, and every quarter we must turn in our taxes to these 2 agencies, the federal and the state. So we're going to go ahead and multiply 400 times 13, 700 times 13, and $900 times 13. So 400 times 13 gives us $5,200. Employee B gives us $9,100. Employee C, it gets $11,700. So you see employee A did not reach the $7,000 earnings yet. We're going to pay, employers will pay tax on that. However, you see employee B and C did reach the $7,000, so we're going to pay on it the $7,000 earnings. However, what we do first is we're going to go ahead and add these 3 earnings. $5,200 plus $7,000 plus $7,000 gives us a total of $6,600. What we do next is multiply 6,600 times 0.06%, which that gives us $396 for a federal. And for the state, we're going to multiply 6,600 by 5.4%, which that would give us $356.40. FUTA and SUTA. And this is what we're going to be sending out to the agencies every quarter. So let's take a look at the second quarter. Let's see, second quarter. Notice this first employee did not reach the 7,000. However, he did get paid 5,200 again this quarter. So now he's reached it. There's a difference here. 5,200 plus 1,800 equals 7,000. So the difference is 1,800, right? So what we're going to do is we're going to pay the taxes on $1,800. So here we go again. 18 times 0.06% gives us $108. Now $1,800 times 5.4% gives us 97.20. And those are the taxes we're going to be sending in for the second quarter. However, let's take a look at quarter three. Let's take a look at third quarter. Now let's see, these three have paid their earnings. Does that mean we have to send more taxes on the third quarter? No, we don't. We don't. We are done with those three employees. Yes, we might have other employees that we're still paying taxes on every quarter because they probably haven't reached the $7,000 mark, yet. However, let's say we do hire a new employee in the third quarter, then we would do the same thing all over again. We would start multiplying whatever amount they received for that quarter times 0.06 for the federal and times 5.4 for the state. Every quarter is the same scenario. So I hope today you've learned something, and thank you for watching. Have a good day. Bye.